All right, everyone, today we're going to dive into a really fascinating case study that shows the true power of artificial intelligence in the world of finance. We'll be looking at how AI is being used right now in Indonesia to solve a huge economic problem, helping small businesses get the money they need to grow. This is a perfect example of how AI isn't just some sci-fi concept. It's a real-world tool that's making our economy more inclusive.
Now, that might sound a little strange at first, right? But this question gets to the heart of a massive shift in how we think about credit. The idea is simple. What if all the little bits of data a business creates every day, paying utility bills, their online sales, even their shipping records, could paint a reliable picture of how healthy that business is? Well, that's the whole idea behind something we call alternative data.
So to really appreciate why this AI-powered approach is such a game changer, you first have to understand the problem. In a place like Indonesia, small and medium-sized businesses, SMEs for short, are absolutely essential. They're the engines of the economy, but they almost always hit the same wall. They can't get loans. See, traditional banks only want to see a long, formal credit history, and most of these smaller and newer businesses just don't have one. This creates a huge credit gap, and it holds back a massive part of the economy.
Now, this credit gap, this big problem, actually created a huge opportunity for a new kind of company. Financial technology firms, or fintechs. And what's their secret weapon? You guessed it, artificial intelligence. These companies realized the problem wasn't that these small businesses were bad investments. The problem was that the old-school way of measuring risk was just broken. They needed a totally new way to look at things. And this slide really lays out that shift perfectly. The old way, the traditional bank model, is super narrow. It's basically a yes or no question. Do you have a formal credit history? If the answer's no, you're out. But the new way, the AI way, is completely different. It pulls in tons of different data points, that alternative data we talked about, to build a much richer, more complete picture of a business's health and reliability.
Which brings us right to the star of the show, alternative data. The definition here is pretty simple, but it's incredibly powerful. It's basically any information that isn't a traditional credit score, but can still help predict if someone's likely to pay back a loan. The digital footprint analogy is perfect. In today's world, every single thing a business does, from paying a supplier to getting a customer review, leaves behind a data trail that AI can analyze.
And we're not talking about abstract ideas here. These are real, tangible things. For instance, if you can see a business's sales history on an e-commerce site, you get a real-time look at their revenue. Simple, right? Or what about a record of them paying their electricity bill on time every single month? That tells you they're disciplined and reliable. You can even look at social media to get a sense of their brand and what customers think of them.
So how do you turn all this data into a decision? Well, it happens in 3 basic steps. First, the system gathers thousands of these different data points from all over the place. Then comes the magic. The AI algorithm sifts through all of it, looking for patterns and connections, often relationships that no human would ever be able to spot. It learns what combinations of data actually predict who is going to pay back a loan. And finally, out of all that analysis, it generates a super accurate prediction of the risk, one that's way more nuanced than a simple credit score.
So what happens when you put all this technology to work in the real world? Well, you get a classic win-win scenario. It's a better deal for everyone involved. The AI essentially creates a more efficient and, frankly, a fairer market for both the businesses who need loans and the companies who provide them.
Let's just break down those wins. For the small businesses, the benefit is obvious. They can finally get the money they need to grow their company. This is what financial inclusion actually looks like. And for the lenders, they're able to give out more loans to a whole new group of customers, but they can do it safely. Because the AI's risk assessment is so good, it leads to fewer loans going bad, which is exactly what they want to see.
The big takeaway here is so much bigger than just this one example. What's happening in Indonesia is really a blueprint for how AI can be used to build better, fairer, and more efficient economies everywhere. The core idea is that technology can help us see value where we couldn't before. It shines a light on businesses and people who are invisible to the old systems, and in doing so, it opens up opportunities for everyone.
And that brings us to a huge, forward-looking question. We've seen what AI can do for getting a loan, but where else could we apply this idea of using alternative data to see someone's true potential? Think about it. Could it change how colleges admit students, how companies hire people, maybe even how we approach healthcare? As these AI systems get smarter and smarter, the really critical question we all need to think about is this: how will AI continue to change the very meaning of opportunity in our world?